Welcome to my YouTube channel Equityverse. Today we are diving deep into one of the most fundamental questions in investing. The topic is today the relationship between intrinsic value and market value, the ultimate guide to a smart investing. We have to know what is the relationship between intrinsic value and market value. We say it is in simple, in shortcut, IV value and market value, IV and MV in the whole video. I hope you will anticipate with me. Here is we must to know first of all what is market value and then IV. This is a one line truth. Every smart investor must know it. Market value is what you pay, and intrinsic value, that is IV in shortcut, is what you get. It means the value of the company you will get after analyzing fundamentals of the company from annual reports and data statistics from balance sheet, profit and loss account, cash flow and other parameters, ratio analysis. And the market value is from the where purchasing and selling of the share of the company each prevailed. This single idea separates here investors from speculators. What is the meaning of this? Investors from speculators. I hope you must know it. Investor focus on long-term wealth, accumulates, analyzing fundamentals for steady returns. Investors focus where on long-term wealth, accumulate, analyzing after analyzing fundamentals for steady returns. But speculators seek high risk, short-term profits from market volatility. Investors prioritize security and income, whereas speculators often act impulsive, betting on price movement akin to gambling. And second one is wealth creators from traders. What is the meaning of this? Wealth creators from traders. Wealth creators from trading are individuals who leverage market volatility, deep research and high risk conviction into massive fortune. Ionic Indian examples include like Rakesh Jhunjhunwala. He has started this investment with rupees 5,000. Second one, Radha Krishnan Damani, they are the founder of DMart, and the Ramdev Agarwal. They often shifted from pure trading to long-term investing. And third one is smart money from emotional money. What is this? Smart money represents strategic, long-term, objective investment, whereas emotional money is driven by fear, greed, or insecurity, often leading to impulsive, short-term, and irrational financial choices. To transition from emotional to smart money, investors should build a clear, predefined plan, automate decisions, and control impulsive actions such as panic selling during market dips. I hope you understand all the three terms: investors from speculators, wealth creators from traders, smart money from emotional money. Now come to point market value. What is market value? This is a noisy number because its meaning is market value is the current price of the stock in the stock market. In the stock market, the stock is trading. It changes every second, every day with news, rumors, fear, and greed. That is called market value of the current price of a stock. Market value is driven by what the reasons why market value fluctuates second to second, minute to minute. This is driven by demand and supply of the shares, stock, investor sentiments, news and expectations, short-term emotions. News expectations, the economic condition of India, any release, press release, any new policy by the RBI and other governments position, have taken any decisions and expectation from the shareholders, investors, investor sentiment and demand and supply. These are the reasons that is driven for market value. Market value reflects opinion, not business reality. It is not reality in business, but it is opinion. Market value reflects opinion of the investors. Today's share price rupees 500. This is the market value per share. It may be tomorrow rupees 520 or 470. If there is nothing change in the business, there is no change in business of the company, but is market value, the company's market value traded every second, changes every second. What is intrinsic value? That is IV value. This is the silent truth. Meaning is, what is the meaning of IV? IV is the true economic worth of a company based on, it is the real value of the company, that is called IV, intrinsic value. It is based on future earnings, cash flows, growth potential, business quality. Intrinsic value answers what is the business really worth if I own it for the long term. It is based on the fundamentals of the company. What are the fundamentals? Company's analysis, company's performance, what are the going on profits and past profits and future earnings, what is the cash flow, and what is the potentiality of the company in future, coming future, the growth potential, and also business quality, what is the type of quality of business doing by the business. And what answer? Intrinsic value, IP value. It means what is the really worth value of the business if I own it for a long term, mind it, long term. Key features of IV. It does not change daily. It is based on fundamentals. It moves slowly with business performance. It changes, but very slow on the performance of business. Depends on future earnings, cash flow, growth potential, business quality. Independent of market, there is no any contact of the value of IV with market. It is independent of market mood. IV value is stable, market value is emotional. IV is stable but changes slowly over the performance of the company. But market value is emotional. It changes every second. Then the question arises, why the market value and IV value are different? Because markets are run by humans, not machines. Markets are managing by humans, not machines. Humans may have fear, greed, overconfidence, panic. And what is the result of this? Market value often overreacts. IV value stay grounded and stable. What is the correlationship? Very important for this. You must know it. Over the short term, market value can be above value IV. IV value is based on fundamentals analysis, not on the mood of investors. And market value may be below or above IV. Over the long term, market value moves towards IV value. It is true that market value MV always attract to IV value. So IV value is must. This convergence is foundation of value investing. This convergence meeting, where market value and IV value meeting, this convergence is foundation of value investing. Three scenarios every investor must understood. What are the three scenarios? First scenario is if market value is less than intrinsic value, IV value. This is called undervalued stock. If market is pessimistic, business fundamentals are strong, fear dominates price. These are the reasons where market value is less than IV value. This is called undervalued. Market may be pessimistic, nirasavadi, this is called nirasavadi. But business fundamentals are strong, companies fundamentals are strong, and there is fear in the market of any regions. government will collapse, RBI will issue, and global regions. If American sneezes, then it's felt. It is felt in the situation and the condition of the Indian market, share market. Best opportunity for smart investors. What is the it is this scenario is best for smart investors. How? If suppose IV value is 1000 and market value is 60,000, there is margin of safety rupees 4000. What is margin safety? We will discuss it here in detail. It is a risk reduction technique where investors buy stocks at a market price that is significantly below the estimated IV value. It represents a percentage buffer that protects against inaccurate valuations, market volatility, and unexpected company downturns. What is the formula of calculating margin of safety? That is MOS. That is IV minus MV by IV into 100. If suppose a stock is worth of rupees 100 and that is IV value, and but trades at rupees 70, that is 30% margin of safety. What is the purpose of margin of safety? It acts as a cushion to reduce the likelihood of financial loss. The higher percentage indicates lower risk. Means if this percentage is higher, then it means there is low risk of purchasing this share. Popularized this word, this MOS, margin of safety, popularized by Benjamin Graham. This concept encourages investing when the market price is low, allowing for potential errors in analysis or adverse market conditions. And what are the applications of this? It is used to determine the maximum price an investor should pay to ensure a safety cushion, frequently aiming for a substantial discount to the true value. I hope you understand this margin of safety. Second scenario, market value is greater than IV value. Overlook, this is called overvalue of the stock, where market value is greater than IV value. MV is greater than IV. It is overvalued. Where market is over optimistic, expectation too high, price runs ahead of reality. Where the market is over optimistic, asavadi, and expectations too high, price runs ahead from the reality from the IV value. High risk of there is condition arising how high risk of poor future returns. In second scenario leads to high risk of poor future returns. For example, IV value is rupees 500 and market value is rupees 900. MB value here is MB value is greater than IV. This is risk. There is risk, high risk for poor future returns because MB value tends to move toward IV value. Then there is a risk to high risk for returns may be downward. Third scenario is market value is equal to IV value. That is fairly valued. Both are equal. It is not real. It happen this in real picture, in real condition, but it is equivalent to IV value. The difference between equal and equivalent is fairly. This is called fairly valued. Price reflects reality. Here, price reflects reality. Returns depend on future growth. No big bargain, no big risk. Here is no bargain, big bargain, no risk, no big risk. Now we understand from the case study 1, fear creates opportunity. Here fear creates opportunity. Situation, market crash due to global fear. The stock prices fall 30 to 40%. Business remain strong, but what is the happening in market? There is fear, greed, emotion, but business company is detached from these market sentiments. Then what happened? Market value collapsed, IV value fell only slightly. Due to what is happening in customers of the company's product, seeing their market value, then maybe IV value fell, profit maybe fell, performance may be downward, but that is little bit impact on the IV value, and but fear creates opportunity. Smart investors bought quality stocks. Here, this is the main thing. Smart investors bought quality stocks. Market recovered. Prices moved back toward IV value. This is zero sum game. Price MV always leads to IV value. So it is more chances. It is a natural thing. The market will be recovered. Fear created wealth for the patient. Here, fear created wealth for patients. Case study 1. When greed destroys returns. Situation: a stock becomes popular. Everyone expects endless growth. Then price rises too fast. If we investor tend to being greedy, that may be harmful for the investors. And if purchasing on the greed, a stock become popular and the stock price will be high, will rise, and everyone expect endless growth, no end of the growth, and prices rise too fast. But in reality, growth slowly, slightly, expectation break, market value crashes, intrinsic value remains stable. But IV value remains stable, but market value crashes. Late buyers suffer losses. Overpaying kills future returns. Here, overpaying kills future returns. IV value is not a fixed number. This is the important truth. IV value is not a fixed number. IV value is an estimate, not an exact price. Depends on assumptions. Changes with business performance. It may change with business performance, and it depends on the assumption whether maybe cost of capital and growth percentage assumed for next 5 years, 10 years, and so it is an estimate, not an exact price. But it changes slowly and logically, not emotionally. There is no emotion in IV. And then marginal safety, the bridge between value and price. Marginal safety, earlier I have explained it. Marginal safety is equal to IV value, market value. It protects from estimation errors, market volatility, unexpected events. The bigger the marginal safety, safer the investment. Why most investors fail to use IV, intrinsic value? Why investors fail to use IV value? There is greed and there is fear, so it prevent him to use IV value, because they focus on price charts, follow tips and trends, fear missing out, confuse price with value. They should be awareness. The investors must aware about the fundamentals of the company, so they should depend on the IV value, not on the market price, not the technical analysis on price charts. This is gambling, daily trading. That is gambling. Is also not good for investor to follow tips and trends from WhatsApp, Telegrams, and other experts. But those experts who are fundamental analysts, financial analysts, they may give true analysis on IV of the company. So no confusion should be removed between price and the value. Successful investor reverse this thinking. So from this channel, what is the investing framework we will follow? Price tells you what other things Investor sentiments prevail here in market. So price tells you what other things, and value tells you what the business is worth. Business is worth or not, the value tells you. Profit comes when both meet. When both meet. Price profit come when MV converts to IB value. What the key takeaways for equity first viewers? Market value changes daily. IV value changes slowly. Price can be wrong. Value is anchored. Buy when price is less than value. Patience allows convergence. Here is powerful closing line for equity verse. In the short run, the market is a voting machine. In the long run, it is weighing machine. Smart investors buy weight, not noise. Here is detailed analysis of this quote. What is quote? This famous quote by Benjamin Graham, popularized by Warren Buffett, means that short-term stock prices are driven by emotional popularity and sentiment, that is called voting, while long-term prices reflect a company's actual fundamentals such as earnings and cash flow, that is called weighing. Smart investors focus on long-term IV value rather than short-term noise. The voting machine is a short term. Markets act on emotion, panic, greed, and speculation. Prices fluctuate based on popularity or headlines rather than company value. But weighing machine, what is weighing machine? That is long term. Over time, the market corrects itself to reflect the true worth of the company, focusing on performance and profitability of the company. Buying weight and not noise. Investors should see the weight of the company, not the noise that is in market, that is happening in stock market campus. Investors should disregard temporary market fluctuations, that is called noise, and instead invest in companies with a strong fundamental, that is called weight. I hope you understand today what is the relationship between market value and IV value. I hope you enjoyed this video. So please subscribe my channel. Thanks for watching Equityverse in this video. If you found this deep dive valuable, smash that subscribe button and like the video and hit the bell icon button, bell icon, so that my uploading video can reach to you first off. Drop your biggest aha moment from this video in the comments box. What aspect of Indian market movements confuses you most with IB value? Let me know and I will cover in the next video. Till then, bye bye.